Hi students. So in the first lecture we understood the basic concept of how to prepare the cash flow statement as per IAS 7, and in the next session we have seen what are the missing information and how to find the missing information, and today we will look into the a problem how to prepare the cash flow statement from a given P&L account as well as balance sheet for 2 years. Okay, now let me take an Excel sheet and do the exercise. Okay, so you are able to see the Excel sheet. So we are continuing the same Excel sheet. Okay, so what we will do, for the first 10 minutes we will construct the problem. Okay, then we will proceed with the solution. Okay, so let me take the example. Okay, so when you construct it from the following financial information, prepare the cash flow statement of XYZ Limited, okay, as at 31st December 2022. Okay, they have given very clearly profit or loss account of XYZ for the period ended 31st December 2022. Okay, so what we have been given revenue have been given 400,000, suppose. Then cost of sales you have been given, suppose, say, let we assume 220,000. Okay, you have to reduce this figure from the sales, then you will get the gross profit, gross margin. So it is 180,000, gross margin is 180,000, and you have been given less administration expenditure, less distribution expenses. Suppose the distribution expenses you have been given as 60,000 minus 60,000. Okay, so let me put line here. Then less administration expenses. So you have been given, also you have to minus it 40,000, suppose. Then what is your operating profit? Operating profit. So 1,80,000 minus 1,00,000 is equal to, okay, 80,000. Then you have been given profit on sale of non-current asset. So profit on sale of non-current asset, assume that they have been given 10,000, and you also been given what is called as a dividend income, 5,000, suppose. Okay, then what are getting net operating profit before interest and tax. This called as what? Net operating profit before interest and tax. So how much it is? 95,000. How much it is? 95,000. Check the figures. Okay. Then let me proceed further. So interest expenses given in the P&L account as 25,000. Let's assume minus 25,000. Okay. Then what will get? Profit before tax. So what will get? Profit before tax is 70,000. Called as what? For tax. Then less tax. Suppose tax has been given as 30,000 minus 30,000. Then net profit. Net profit for the for the year. Okay, how much it is? 40,000. Very good. Are you clear? Now, and by the side of it, you have been given the the statement of financial position of X, Y, Z for the, okay, statement of financial position for the X, Y, Z as at 31st December 2022 and 31st December 2021. Okay, and the statement of financial position of X, Y, Z as at 31st December 2022 and 31st December 2023. Okay. So what is the information that have been given to you? So one is 2022, one is 2021. Okay, by the side by side. Okay, so first one is what is called as a non-current asset. How much you have been supposed to assume that it is 500,000. 500,000. Here it is in the case of 2020 is called as 400,000. Let me assume. Then okay, non-current assets at cost value. Non-current assets at cost value. Then less accumulated depreciation, less accumulated depreciation. So you have been given minus 1 lakh, minus 1 lakh and minus 80,000. Assume. Okay, then what you are getting is a net book value. Net book value. Net book value. Here it is 400,000. It is 320,000. Okay. Next, they given you what is called as a investments. 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 How much is given to investments? 1 lakh and 50,000. 1 lakh and 50,000. Okay. Then total non-current assets. Total investments. Then total non-current assets. Total non-current assets. Are you clear? Okay. How much it is? Total non-current assets. So 500,000 and it is 370,000. Are you clear? Next, current assets. Current assets. Okay, let me take one by one item. Okay, inventory. 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 So we can take 60,000 and 40,000. Then receivables. Receivables 80,000. And 90,000. Then cash. Cash and bank balances. So you have been given 20,000 and dash dash. Okay. So this value increased on 12. Next. So current assets over. So total assets. When you add total assets, you add all these things, then you'll get total assets. Okay. So how much is the total assets? And look into, it will be 6,60,000 and 500,000, or 660,000 and 500,000. Now capital and liabilities. Capital and liabilities. Okay, how much is the capital and liabilities? So in that, share capital of $1 each. So it is 200,000, 2 lakhs, and 150,000, 1,50,000. Then revaluation reserve. Revaluation reserve. Okay, 1,50,000. Then 1 lakh. Then retained earnings. Retained earnings. Earnings are 1 lakh. 1 lakh. Okay. Then non-current liabilities. Non-current liabilities. In that, let me take 6% loan notes. 6% loan notes. Okay, 1,50,000 and 70,000. Let me take, assume. Okay, then there are 8% loan notes. So 8% loan notes in the year 22 is 0, but in year 21 it is 30,000. Okay, and apart from this, you have what is called as current liabilities. Okay, what are the current liabilities? You can take it. Trade payables. Trade payables, how much you can take? 30,000 and 40,000. Then comes to the tax payable. Tax payable has been given as what is called as 20,000, and assume that 32,000. Then interest payable. Interest payable. So let me assume 10,000 and 8,000. Okay. Then look into bank overdraft. Overdraft. So how much is the bank overdraft? Okay. So there is nothing in the year 2022, but in the bank overdraft is 20,000 in the last year. Okay. Now let me total the all the capital and liabilities. So how much you are getting? So it's 6,60,000 and 5,50,000 is coming. Okay. So 350, 450, 450, 100, 550. Okay. So we can reduce the capital by 1 lakh. Okay. So that balance sheet agrees with it. Okay. So our now now they have given some additional information. Let me put additional information. Okay, what is the additional information? Number one, during the year, the company, okay, sold a part of PPE, part of property plant equipment, okay, for dollars 35,000, okay, whose book value is 25,000, okay, whose book value is 25,000, okay, and the accumulated depreciation on disposed asset is 15,000. That is point number one. point number 2. During the year, the company revalued the asset. Okay. Prepare cash flow statement of XYZ Limited for the period ended 31st December 2022. Okay, you have been given this information. Are you clear? Do you understand? Okay, now let us continue with the preparation of the cash flow statement based on the information we have. So we have been given the P&L account. Please observe once again. You have been given the P&L account. Okay, very clearly. Then we have been given the balance sheet for 2 years period. Okay. So considering this one, okay, and they have given two information. One is during the year the company sold a part of the PPE for 35,000, whose book value is 25,000, and the accumulated depreciation on disposal asset is 15,000. During the year the company revalued the assets. Okay. How to find the company has revalued the asset? They didn't mention how much it is, but when you come to the revaluation surplus, so last year it is 100,000, now it became 150,000. That means 50,000 increase. They didn't mention in the note, but you can identify how much is amount. Okay, so where this revaluation reserve goes, when you prepare the PP account, revaluation reserve increase will go to the PP account. Okay, now let me start preparing the cash flow statement. So first of all, you need to put the heading. Okay, what is the heading? Cash flow statement of XYZ Limited. Sorry. For the period ended December 2022. Okay. Okay. What is the first element? We know very clearly the first element is what? Net calculation of net cash flow from operating activities. Okay. So for this, what is the starting figure you have to take? Profit before tax from the P&L account. Now go through the P&L account. What is the profit before tax that is given in the P&L account? So profit before tax is 70,000. So take the 70,000 is the starting point for you. So 70,000 we have taken. Very good. What is the next? Add depreciation immediately. Add depreciation charged in the current year. Okay. But depreciation charge in the current year, they didn't mention how much is in the P&L account because the depreciation is a part of cost of sales. But how to identify? They given one clue. What is the clue? They given already accumulated depreciation in the balance sheet. Okay, highlighted figure. So you take those figures and what is the amount of depreciation on the disposed asset? You take these three information and calculate what is the amount of depreciation that is charged in the current year. Okay, now let me go to the by the side of this one. Okay, are you clear? So they are given the opening balance as well as the closing balance. So prepare simple T account format. So prepare simple T account. So this account is called as what? Accumulated depreciation account. Noted. Or provision for depreciation account. Whatever you say, it is one and the same. Okay, provision for depreciation or accumulated depreciation account. Since it is a liability account, opening balance will be on the credit side. Now opening balance means last year. When you see here in the net non-current assets, they given very clearly accumulated depreciation. Opening balance 80,000. Okay, for last year, current year it is 100,000. So take 80,000 and 100,000. 80,000 is opening balance. You take on the credit side, and closing balance on the debit side. Closing balance, how much it is? 1 lakh. So you write closing balance 1 lakh. Very good. Now, what else you have to take? I said very clearly in the second lecture, in case any asset is disposed in the current year, on the disposed asset, if there is any accumulated depreciation, that you need to reverse it. Because when the asset is no more, accumulated depreciation on such asset also should not be there in the books of accounts. You have to remove. Remove means you have to debit it. Okay, depreciation on accumulated depreciation on disposed asset. How much it is? When you look at the notes, they said very clearly. Okay, so when you read the note very clearly, it says very clearly, during the year, the company during the year, during the year. Okay, the company sold a part of PPE for 35,000, whose book value is 25,000, and accumulated depreciation on the disposed asset is 15,000. So 15,000, that 15,000, whatever it is given, you take on the debit side of the accumulated depreciation account. Now, when you look into here, when you balancing it, there is a gap that exists on the debit side. Okay, so how much is this one? 115,000. So take the same figure, 115,000 on the credit side also. So how much is the depreciation that you can find out? Depreciation that you can find out is the balance figure. So 115 minus 80,000 is equal to 35,000. Are you clear? This is called as a depreciation charged to PRL account. PR, okay, L account in current year. Are you clear? This is a balancing figure. You can say balancing figure. This amount goes to the calculation of here operating activity. So 35,000 you have to add. So we calculate the balancing figure and we bring here. Then next one is what is called the add back interest. Add interest expenses as per PRL account. So please look at the PRL account. Please look at the PRL account. How much is given interest expenses? 25,000. This 25,000 you need to add back because we have taken after interest. So 25,000 you can. Very good. Then after these two, we said very clearly, any non-operating activities are there, you must adjust it. So they said in the P&L account, when you look into, they said very clearly, profit on sale of non-current asset, very clearly given to you. This is not relating to operating activity. So thus you need to adjust it. How to adjust? Because with this your profit has been increased. You should eliminate. When you eliminate means you should reduce. So less profit on sale of PPE. How much it is? 10,000 minus 10,000. At the same time, in the current year, they also have what is called as a dividend income. They also mentioned it, dividend income 5,000. That is also not relating to your operating activity. So you must reduce. So less, okay, dividend income. So you take this dividend income when you prepare the investing activity. Are you clear? Where to take? Investing activity. So 5,000 we removed. Apart from this, what you have to look into, any changes. So we have taken very clearly non-cash item depreciation, non-operating item like a profit on sale of PPE and any other incomes other than your regular trading or activity income. Okay. Next, working capital changes. So what are the working capital changes? You need to what is called look into inventory increase, decrease, receivables increase, decrease, payables increase, decrease. Now go to the balance sheet now. So in the balance sheet, inventory, what happened? Compared to 2021 and 22, there is increase of 20,000. Why? 40,000 is the opening balance, closing balance is 60,000. That means how much increase compared to previous year? 20,000 increase. So take the 20,000 increase. Okay. So increase in inventory is minus because you are acquiring inventory. So it indicates very clearly outflow of cash. So less increase of inventory. So increase of inventory, how much it is? Minus 20,000. Next item is what? Receivables. Receivables, what happened? Please see the receivables, what happened? 90,000 in the 2021 becomes 80,000 in 2022. So what I'm supposed to do? There is a decrease in the receivables. Decrease in the receivables will increase the cash. Why? Because you are realizing money from the customers. So add, okay, decrease in receivables. How much it is? 10,000. Are you clear? Okay. Then next one is what you have to see? Payables. So payables already here. So payables, when looking to here, what happened? 40,000 is opening balance, becomes 30,000 closing balance. Last year 40,000, current year 30,000. That is, what does it indicate? Indicates very clearly there is a decrease of payables. Decrease of payables is always cash outflow. Increase of payables is cash inflow. Okay. So less, okay, decrease of payables. How much it is? This is another 10,000. Okay, minus 10,000. Decrease means less. Very good. Okay, so what you take? You take non-operating, non-cash, and working capital changes. When you do all these things, what you will get? Ultimately, you will get cash generated from operations. What you will get ultimately? Cash generated from operations. Are you clear? So this figure is called as 95,000 figure is called as what? Cash generated from operations. Very good. From this, what are supposed to do? Always less standard, less interest paid, less tax paid. So you need to calculate these two figures. Now let me come to the preparation of T account. Okay. So how to prepare interest, okay, paid, how to identify interest paid. So if you prepare the interest payable account, interest payable account. So is the liability account, opening balance will be credit. So what is the interest payable account? Here it is identifying interest payable. Opening balance is 8,000, closing balance is 10,000. Okay. So 8,000 you take opening balance and closing balance. Okay. You take closing balance. How much it is? 10,000. We have seen already. Very good. Now, whatever the interest that is given in the P&L account, you have to credit to the interest payable account. So please check what the interest given in the P&L account. As per the P&L account, please see interest expense. How much is given to you? 25,000 is given to you. How much is given to you? 25,000. So take that interest. Okay, interest as per P&L account. Interest expense as per P&L account. How much it is? 25,000. Now you will get the balancing figure on the debit side. Okay. So when you look at the totals, how much is the total? Total is equal to 33,000. Then 33,000 you bring this side. Then what is the balancing figure? Because you have opening balance of 8,000. By taking interest expense 25,000, total becomes 33,000, but your closing balance shows only 10,000. That means they have paid interest 23,000. How much they paid interest? 23,000. So this is interest paid in cash. Interest paid in cash. Okay, this is balancing figure. Balancing figure. Okay, this you have to show in the operating. This you have to show in the operating. So interest paid, how much it is? Minus 23,000. Minus 23,000. Are you clear? Then tax paid. Tax paid also have to prepare the account since they have given the opening and closing balances. Since they given what? Opening and closing tax payable. Please understand, in the case of tax payable, there can be deferred tax also. In case a deferred tax is there, you have to take the what is called as corporate tax and deferred tax opening balance, and corporate tax, deferred tax, closing balance. That means last year and as well as the current year also, both corporate tax and deferred tax. So now let me prepare a small T account to calculate how much tax has been paid. Okay, so let me prepare the T account. So this T account is related to tax payable account. So since it is a liability account again, so opening balance will be on the credit side. Okay, so opening balance. In case deferred tax, once again I'm telling you, in case deferred tax is also there, you have to take corporate tax as well as the deferred tax, both together, opening balance. So opening balance, both corporate tax and deferred tax. Opening balance, okay, corporate tax, okay, and deferred tax. Both you have to take, but in this example, you do not have deferred tax. Okay, so corporate tax, how much is given opening balance? Please see the current liabilities. As per the balance sheet, how much is tax payable? 32,000 opening balance, 20,000 closing balance. 32,000 opening balance. So put 32,000 opening balance and closing balance 20,000. So every time you have to check the figures. Then whatever the tax that is given in the P&L account, you have to credit to this account. So go through the how much is given in the P&L account tax. Tax is given 30,000 in the current year. So the 30,000 you have to take to this tax payable account. So tax as per P&L account. Tax expenses or tax expenses as per PRL account. Tax provision, you can say PRL account. Okay, taxes. Okay, how much it is? 30,000. How much it is? 30,000. So, okay. Now, you have opening balance of 32,000 and a current year tax of 30,000, but your closing balance is showing only 20,000. That means you might have paid some amount of tax in the current year. How much it is? So, what is the total? 62,000 should have been there. 62,000 should have been there, but your closing balance is showing only 20,000. Okay, so in that case, what is this? The balance is called a cash. Okay, tax paid in cash. Okay, how much it is? It is okay. Closing balance 20,000. 62 minus 20,000 is equal to 42,000. Are you clear? Hello. Okay, 42,000. Hope you are able to understand. Okay, so this again balancing figure. Okay, so this you have to take to the operating. So how much is we have to take to operating? So here we are coming to operating minus 42,000. Very good. Now we've taken all the items that are minimum required for preparing the net cash flow from operating activities. So cash generated from operations minus interest paid minus tax paid will give you the okay, what is the cash generated from net cash generated from operating activity. Okay, net cash flow from operating. How much it is? 30,000. So you take 30,000 in the outer column. Okay, this called as what? Net cash flow from operating activity. Net cash flow from operating activity. Very good. First item is over. Let you put in the outer column. Okay. Then what is the second element you have to look into? Second element is called as net cash flow from investing activity. Okay. What is the starting point for this? Always you write very simply. Okay. Less purchase of non-current assets. That is PPE. Anything, maybe PPE, maybe furniture, maybe anything, maybe property, anything. So that you need to identify. And in this question, it is very clearly mentioned during the current year, there is a sale of PP, part of the PP for 35,000. Please see the note, one note already given to you. Please see the note. Note says very clearly, during the year, the company sold a part of PP for 35,000. So they sold for 35,000. Are you clear? So in the cash flow, you have to show very clearly sale of PPE. Sale of PPE. Okay, how much it is? 35,000. Very good. That is inflow. So you take it. But what is the purchase of non-current asset? For that, you have to prepare PPE account. So let me prepare the PPE account. So how to prepare the PPE account? So first take the T account format. PPE. Put the heading. So PPE account or non-current asset account. Whatever the way you want to say, you can say. Since PP is an asset account, opening balance always debit, closing balance will be credit. So you write simply opening balance. So here you can get a question, which one you take it? Always it is better to take based on net book value. Always better to take net book value. Because in the given question, the balance sheet when you look into, please look into, you have been given very clearly cost value of the asset, depreciation minus you have been given net book value. You can prepare the account using the net book value. You can prepare the account using the cost value. But you follow one method, either using the net book value or using the cost value of the asset. The difference I will tell you later on. Okay. So for the time being, you take the net book value. So what is the net book value? Opening balance 320,000. Opening balance 400,000. Closing balance. So take 320,000 opening balance. So go down. So 320,000 opening balance. 320,000 opening balance and closing balance. Closing balance 400,000. Are you clear? You have taken. Very good. These are the two standard items, opening balance, closing. Then what will be credited to this PP account? Current year depreciation. Depreciation charged in PR account in current year. That we already calculated above. That already calculated while preparing the accumulated depreciation account. How much is depreciation charge in the current year? 35,000. Take that 35,000 here. Number one. Next, any asset is disposed. When any asset is disposed, you can take the sale value or you can take the net book value of the asset disposed. Better always take the net book value. Okay. So what is this? Disposal. Disposal of asset. Disposal of PPE. How much it is net book value? So when you come to the notes that is given, additional notes given to you, they said very clearly, during the year, the company sold a part of PPE for 35,000, whose book value is 25,000 only. So 25,000 book value of the asset is sold for 35,000 and made a profit of 10,000. Are you clear? So what amount you have to reduce here when you prepare the PPE account? So you have to reduce 25,000. Are you clear? Then, in case you take 35,000 actual sale value, then you have to show on the debit side profit on sale of asset. That is one that you need to keep in mind. Then apart from that, what you have to show here, in the current year, they given one more note in the Okay, in the net during the year, the company revalued the asset. Okay, that one I already told in the beginning. So how much they revalued in the current year PP? 1 lakh, because the revaluation has been increased from 1 lakh to 1,50,000. Okay, that means 50,000 is the revaluation surplus that has been added in the current year. So with that, what happened? Your PPE account will increase, no? With the asset revaluation, PPE amount will increase, no? So revaluation surplus. How much surplus in the current year? 50,000. With the 50,000 surplus, your PPE amount will increase. Very good. Are you clear? Then what else is there? Then what else is there? There is no any additional information. So you charge depreciation in the current year 35,000. You dispose the asset for 25,000 in the current year, and still your closing balance is showing 400,000. That means, okay, you might have purchased some asset in the current year. Are you clear? Okay. So take that 460,000 on the debit side. Then there is a balance figure. So how much it is showing? How much it is showing, my dear? Please check it. Please check it. So your opening balance 320, revaluation of asset 50. That is becoming only 370,000 only. Whereas your balance is showing 460,000. That means you might have purchased some additional asset in the current year. How much is additional asset? So this is called as PPE purchase of PPE. Purchase of PPE for cash. For cash. Okay. So how much it is? If you want to calculate this figure, so what you can do? So you put Excel formula is equal to this closing balance minus 3,20,000 minus 50,000. So that will give you how much it is? 90,000. This is the balancing figure. Is it balancing figure? So take this balancing figure when you prepare the investing activity. How much is this, my dear? 90,000. So this 90,000 where you have to take investing. Okay, so purchase of PP, how much it is? 90,000. This 90,000 is outflow, minus figure. Please keep minus. Sometimes most of the students come to mistake while putting these symbols minus, because adding and subtracting, so they don't put properly less. They write less, but they don't put this symbol. So thereby, okay, instead of adding, we reduce. Instead of reducing, we add. So we have taken the what is called as purchase of, okay, PPE, non-current asset, as well as sale of PPE. Then what else will come? We said very clearly, what are the non-operating incomes are there, we reduced while preparing the operating activity. That non-operating income you have to take to the investing activity, because you received dividend income. Means what? You might have invested some shares or some securities. That is why you received some dividend income. That dividend income you have to take here. Dividend income. If nothing is given in the balance sheet as a dividend receivable, you need not prepare any account, and whatever the dividend that is shown, dividend income that is shown in the P&L account is deemed as received in the current year. Okay, how much it is? That one? 5,000. Okay, check it once again. Please check the P&L account that is given. Dividend income, how much it is? 5,000. This 5,000, when you prepare for operating activity, we removed here. Okay, now we are taking here in the investing. Okay, please understand. Are you clear? So we have taken. Then one more thing, because you have to look into the balance sheet closely. When you look at the balance sheet closely, what happened? So already PP already taken. Okay, non-current is already taken. There is one more, investments are there. Investment previous year 50,000. In the current year it is 100,000, and nothing has been mentioned in the question about a disposal of any particular investments. So simply 50,000 become 100,000 means they might have purchased. They might have purchased this particular investment. So purchase of investment is outflow that will come in the investing activity. So you write purchase of investments. Okay, how much it is? 50,000. 50,000 is also outflow. Are you clear? So we have mentioned. So now how much is the, though there is no any other information, so how much is the net figure that you are going to generate from the investing activities? 100,000 minus. So this 100,000 minus, you take on the outer column. Take on the outer column minus 100,000. Very good. Okay, now we have to go for the third one. What is the third one? You know very well. The third one is called as net cash flow. Calculation of net cash flow from financing. Okay, put the heading. Now, what is the starting point for this? Which one you are going to take here? Any capital increase, any capital decrease, any loans increase, any loans decrease, and equity dividend paid. Sometimes you have to take lease liability also, but in this question, lease liability is not given to you, so you need. So go to the balance sheet now. Okay, share capital. What happened? Share capital 100,000 has become 200,000. That means in the current year they might have issued additional shares. Are you clear? So now put that increase of share capital. Increase of share capital is inflow. Increase of share capital is what? Inflow. You write increase of share capital. Increase of share capital inflow. How much it is? 100,000. Very good. Then look into next item. One by one item you have to look into. So share capital increase already taken, revaluation surplus already taken, retained earnings. This also you need to look into. Okay, that you can find out when we prepare the calculation of dividend paid, equity dividend paid. Now look into the non-current liabilities. What happened? 6% loan notes. 70,000 has become 1,50,000. That means there is an increase of 6% loan notes. At the same time, 30,000, 8% loan notes are not there in the current year. So that indicates very clearly 8% loan notes they might have paid by taking the 6% loan notes. Possibilities are there. So they acquired additional loan notes of 6% for how much amount? So what is the difference? 70,000 becomes 1,50,000, means 80,000 they acquired additional loan notes. Okay, they issued additional loan notes. Okay, so increase of 6% loan notes. Increase of 6% loan notes. How much it is? 80,000. Very good. That is inflow. Very good. At the same time, there is a repayment of 8% loan notes, because last year the 30,000 is there. This year there is nothing. So what happened? They repaid. So decrease of 8% loan notes. How much it is? 30,000. The minus 30,000 because you repaid. Then one more important thing that you need to always keep in mind is the equity dividend paid. Please understand your retained earnings as given in the question. Please understand your retained earnings as given in the balance sheet. How much it is retained earnings given? Opening balance also 1 lakh, closing balance also 1 lakh. But in the current year, you made a profit of 40,000. Please understand your opening balance is 100,000. Your closing balance also 100,000. How it will be possible? Because your opening balance is 100,000. In the current year, you made a profit of 40,000. That means your closing balance should be 140,000, but your closing balance is only 100,000. So that indicates very clearly you might have paid some dividend in the current year. Are you clear? So already clue is already mentioned to you. So how to calculate the dividend paid? So here you can take simply opening balance of retained earnings. How much it is? 1 lakh. To this you add simply current year profit. Current year profit. How much you made current year profit? 40,000 you made. Okay. How much it should be with you? At least it should be with you. How much it is? 140,000 should be with you. But your closing balance is showing only 100,000 again. So minus closing balance, less closing balance, less closing balance. So how much it is closing balance? It is minus 100,000. So what does it indicate? So it shows very clearly there is a payment of dividend of 100,000. Okay, this is called as what? Payment of equity dividend. Payment of equity. Are you clear? So that equity dividend you have to bring here to the operating activity. So look at the operating activity. What are the financing activity? Sorry. So you say payment of equity How much it is? 40,000 minus 40,000. Always, unless it is mentioned unless it is given very clearly in the question, you must take, okay, equity calculation. Very simple. But sometimes you may require to prepare a quad share capital account also. Sometimes share capital can be given for purchase of non-current assets. Possibilities are there. Sometimes you may acquire the what is called as a leased asset. All these things you have to take to the asset account. Okay. Now, so how much is the net it is coming to? Net is coming to 110,000. So this 110,000 you take. So is it 110,000 positive? Okay. So you take 110,000 positive. So this is called as what? Net cash flow from financing. Okay, activity. So now we have all the three. Okay, net cash flow from operating is clearly known to us. Then net cash flow from investing, activity, also known very clearly to us. We calculated, that is 100,000, that is negative. And we also have the third one, net cash flow from financing. So all the three we know very well. So what are supposed to do? All the three elements you add together. Then what you will get? You will get either surplus or deficit. What you will get? Either surplus or deficit. So here you are getting positive. Why? 30,000 positive, 1,10,000 positive. So it is become what? 1,40,000 positive. But 1 lakh is negative from the investing activity. So this is called as what? Surplus of cash. Okay. Now, once identify this one, what you have to take? You have to take opening balance of cash and cash equivalent. Cash equivalent. Okay. Now go to the balance sheet once again. Let me look into. So when you look into the current assets, your last year there is no cash balance. Please look into. But current year there is a cash balance. And when you come down to the balance sheet, last year your bank overdraft is 20,000. Bank overdraft is a negative cash. Please remember, bank overdraft is a bank OD, is a negative cash. So what are you supposed to do? You do not have any positive cash balance, but you have a negative cash balance opening. Are you clear? You do not have any positive cash balance, but you have a negative cash balance opening. Are you clear? So what are you supposed to do? So what is the opening? Bank overdraft. How much it is? 20,000. So overdraft is negative balance, no? You reduce it. Opening balance of cash and cash equivalents, what you have? Only bank overdraft. So now you have to identify what is the balance. Now the balance is how much it is? 20,000. This 20,000 is equivalent to what? Closing cash and cash equivalents. Closing cash and cash equivalents. So how much is cash? Closing cash and cash equivalents? 20,000. Now check with your balance sheet again whether this figure is correct or not. Sorry. So cash and cash balance, how much it is? 20,000 is there in the current year. But when it comes to overdraft, there is no overdraft. So how much cash balance you have? Sorry. How much cash balance you have? 20,000. No bank overdraft, no other. So this equals to this 20,000. This equals to this 20,000. So this 20,000 cash is agreed with the balance that is mentioned in the balance sheet. So now you can cross check whether your answer is correct or not. So most of the cases, if your closing cash and cash balance are matching with your balance sheet values, with cash, overdraft, what it means, short-term investments, if it is given, all these things, when you look together, it must be equal to that amount. So here, when we cross-check it, so you have a cash balance. How much you have cash balance? How much you have cash balance? 20,000. Okay, that's matching. Are you clear? No other. So this is what you need to understand in the preparation of the cash flow statement. Okay. So once again, please go through the question, go through the P&L account and balance sheet and how we prepared in a systematic manner. So first, you can also put very clearly the format, because standard items there is always will be there. So you put the format, and better to put the values by calculating or identifying the missing information. Are you clear? Are you clear? So with this we'll close, and tomorrow we will take one more problem with which can have more than 2 or 3 4 adjustments, so that how you can, including leasing, including government grants, we will take it, okay, exam type problem, so that will help you to solve the cash flow statement. Are you clear? Thank you. So please go through the question, the answer side by side. Always you have to refer your problem. Then only you can do it. What is given in the P&L account? What is given in the balance sheet? Then what figures you have to take? So do not take any cash balances in the directly to the cash flow statement. No. Okay. So please go through, and if you have any question, please call me, as I have already given my number in what is called as the first lecture. Okay, those who cannot call, they can give email also. So I'll mention my email. Okay, guti1959@gmail.com. Okay, so please, those who cannot call, they can email. And if you need any help on any of the what is called as elements means any lectures, like what is called as non-current assets, if you cannot understand, or taxation you cannot understand, or EPS you cannot understand, any item, any what is called as concept you cannot clear, please let me know. I'll put immediately, as far as possible, the lecture, so that you'll understand. Okay, thank you for watching. Okay, and please share and please subscribe. And tomorrow I'll give you one more example with many adjustments, so that will give you more understanding, including the leasing adjustment, including the government grants adjusting. Okay, including sometimes there can be adjustment in the interest payable also. Interest payable and interest receivable, they will adjust it, net it. In that case, how to do it. So we'll see a little bit better. Okay, example, so that you will understand very clear. So I'm stopping the recording. Thank you very much for your support. Thank you.